Hey guys, today we are going to talk about conventional financing, the jack of all trades, and how much money do you really need to put down. So here we go. Last week in my previous video I talked about FHA financing. Today we're going to talk about conventional financing, and the things about conventional financing that always pop out when I even talk about a conventional loan with people is they automatically think they have to have 20% down. Now, if you're looking to buy an investment property, you have to put 20% down. That's a rule. Buying an investment property, 20% down. If you're buying units, so duplex, triplex, fourplex, sometimes you have to put 25% down if you're buying it as an investment. But if you're looking to buy as a primary residence, you can put as little as 3% down. 3%. That's 0.5% less than FHA financing. So why don't more people do that? Why don't they put as little down as 3%? Well, the caveat is you're usually going to have more mortgage insurance. So your mortgage insurance and how much that you have to have on your loan is going to be based on how much money you put down and your FICO scores usually. So if you have really good FICO scores, even if you're only putting down 3%, sometimes the mortgage insurance isn't that bad. But that's something that comes into play. But most people think they have to have 20%. So why 20%? Well, if you put 20% down, you don't have to have mortgage insurance on your loan. If you're buying a primary residence, you put 20% down, no mortgage insurance. Is it always worth it? Not always. Because, sometimes if you, let's say you have 10% to put down, and you decide, I want to put another 10% down. Sometimes that's $20,000, $30,000, $40,000, $50,000 to save on what your monthly mortgage insurance might only be $50, $60, $70 a month. Is it really worth all that extra cost? It really just depends on how the numbers shake out for you, if that makes sense or not. But that's the biggest thing I get with conventional financing. It's kind of the jack of all trades when it comes to home loans, because you can use it for a lot of different things. Now, the debt to income ratio threshold on it is lower than FHA. So that's why it's not always used as a primary purchasing vehicle when it comes to first-time home buyers. They don't always have the extra cash if they want to put more down. They don't always have the highest FICO scores or the lowest debt to income ratios, and that's why it's not always the most common one, but it is usable. I used a conventional loan when I bought my home as a first-time home buyer because the numbers actually just made more sense. Even with the guidelines between FHA versus conventional, it just panned out to be a better deal. And only your loan officer is really going to be able to tell you if it's a better deal or not, but you need to at least be aware of what the differences are when it comes to conventional financing. So most people would think it's 5% down, 10%, 15%. You can literally put down anything between 3% or more if you want. You can put 50% down if you want to. But conventional financing usually has that kind of that leeway with it. Now, usually your appraisal, you'll still have to do an appraisal, but it won't be as strict as a VA appraisal or an FHA appraisal. There's a little bit more leeway with the condition of the property. It still has to be safe, but there might be some paint peeling on the outside of the house and the appraiser may not care about that. So it's going to be a little bit more flexible with conventional. In terms of, qualifying for them is the same as if you're looking for FHA, but like I said, you typically need to have a little bit better income, a little bit lower debt, and how your interest rate is affected primarily is going to be by how much money you put down, how much you're borrowing, so how big is your loan amount, but how much you're how much you're putting down, but also your FICO score. So the interest rates when it comes to conventional are more FICO score driven. So if you've got a 720 or 740 FICO, you're probably going to be getting the top tier pricing when it comes to an interest rate. If you're in like the high 600s to mid 600s, your pricing is not going to be as good as it could be. And that's sometimes that range where we say, well, why don't we look at FHA because maybe you can get a better interest rate. Because conventional rates in general are slightly higher than most of the run-of-the-mill FHA or VA rates that are going for maybe the same type of purchase scenario. So that's just something to be aware of. It's still a great loan product. If you end up putting less than 20% down and you have mortgage insurance, it will cancel at a certain point. Usually when you have that 20% equity or so, you can cancel the mortgage insurance and drop it. With FHA, it takes a lot longer or it takes more time. And I think even as of most recent with guidelines, it wouldn't come off for a long time until you had to really prove you had a lot of equity. With conventional, it'll come off. So your payment will lower just over time by paying it. and with appreciation. It's one of those things, you get a conventional loan, you can even reach out to your servicer and say, I think I got 20% of equity. Can I drop my mortgage insurance? And sometimes they'll say, well, let's check it out. And they might even drop it depending on how long you've owned the home. So that's another cool little tidbit that could save you some money. So yeah, this is just another video in the series of what different loan types are. If you like this video, give it a thumbs up. Comment down below if you have any questions. I would love to interact with more people about this and answer any questions you might have. I did do a video on FHA, so if you didn't see that, I'll go ahead and I'll put it around here somewhere so that you can click on that and give that a watch, because it's kind of interesting and some good information there. But yeah, so it's good talking with y'all, and we'll see you next time.